Great. So the strategy here is to my strategy here is a strategy for people to accumulate more money for retirement. I'm not sure if pre-retirees is exactly the best word for this, but it could be more people in the accumulation phase, people that are trying to save more for retirement. And really what we're looking at is what I would call a life insurance retirement plan. So a life insurance retirement plan is just simply an insurance policy that we're overfunding for cash value accumulation. And the idea is that they're going to build up a fund that's going to be much like a Roth IRA. So optimally, they've got a number of years to save and accumulate. And the underlying benefit here is that you're going to be able to draw out tax-free income, which I think is a huge benefit for many people. So one thing that I want to identify before we really get into this is just who is an ideal candidate for this? Who is someone that this could work for? Really, somebody's got to be insurable, number one. So they have to be able to buy insurance. Number two, they have to have at least 10 years to save. And number three, they have to be willing to contribute, and there's a typo, willing to contribute at least $1,000 a month, at least for me. Some people can go a little bit lower than that. I mean, I typically look at it as, somebody's going to want to put in a reasonable amount. I'm going to be stuck with this. I'm going to service this policy for a very long time. So, I want to make sure that the amount that they're putting in is enough for me to be there and able to service them and willing to service them, basically. So before I go too deep into this, Advisors Resource Company, that's our company, the company that I'm with, one of our biggest value propositions for the agents that we work with is tailored yet simple presentations. And with this presentation that we're going to go through actually today, this is something that we put together for the agents that we work with. And I think what you'll find is this presentation is simple and it's easy for a client to understand. And it's easy for you to demonstrate why a client might want to do the plan that we're talking about today. So moving on from there, this is the type of presentation that we're talking about. And so again, this is a life insurance retirement plan, an overfunded insurance policy that we're going to leverage for somebody to save for retirement, or utilize for somebody to save for retirement. And if you see my presentation here, primarily we've got a sample company logo here that in theory, if you were working with us, would be your logo. And that logo actually matches the color scheme of this presentation. So if you're working with us, then obviously we would include your logo. You'll notice the stock photo guy, it was kind of a middle-aged male. We can tailor this to whomever you're working with. So whatever gender or race or age that that are kind of associated with the person you're working with. So anyways, this is just the first 2 pages, and this goes on. I'm going to present this like or as if you were a client, so to speak. But when you're saving for retirement or really any other purpose, there's multiple ways to save. So the first one is taxable investments. So taxable investments, as they grow, you pay taxes on the growth, and it could be capital gains, it could be ordinary income, depending on the type of growth, if it's interest earned or if it's capital gains. But the bottom line is you're going to pay taxes as it grows. You have tax deferred accumulation vehicles. So those are effectively annuities. Annuities are taxed at ordinary income, but they're only taxed when you pull the money out. So the taxes are deferred until you take it out. The real downside for maybe some of your younger clients is that an annuity has a 10% penalty if you take it out prior to 59 and a half. So that's not, that's not ideal, obviously. You have qualified plans. So when you're talking with a client or anybody really, most of what they're used to is saving in a qualified plan, which, you got the deduction on the front end, but you pay taxes on the back end. And then finally, you have insurance. And I don't know if you know this, but cash value insurance can grow tax deferred, and then you can actually take it out without paying taxes on it. So it actually operates much like a Roth. So there's a lot of benefits to that type of plan. So secondarily, the type of insurance that we're looking at, and I'll point to this next page on the right-hand side, is an indexed universal life policy. And one of the chief benefits of an indexed universal life policy is the fact that you have the floor of zero. So I'll usually kind of highlight the floor of zero right there, and or even point to it if I'm doing a face-to-face type of meeting, but I'll definitely highlight that for somebody to, to notice, or, to make sure that they recognize that. Now, hopefully I can get this green mark off of my page here. Nope. There we go. So let's move on to the next page. So I'm over here on the left-hand side, and I usually just go straight down this advantages, disadvantages chart, and just simply highlight the underlying benefits of the insurance. And so, as you can see, insurance, the only thing that has tax deductible contributions is going to be your qualified plan. So I definitely highlight that. But then income tax deferred growth of values, the insurance has that, as well as the annuity, as well as the qualified plan. There's no contributions, no contribution limits for the insurance and the taxable investment and the annuity. There's no 10% penalty for distributions prior to 59 and a half, and that's the insurance and the hypothetical taxable account. No RMDs. The only thing that has RMDs is the qualified plan. And the most important one is the distributions are not taxable. So distributions aren't taxable in the life insurance. I have favorable estate tax treatment if it's structured properly, at least the life insurance and the hypothetical taxable account. Income tax-free death benefit, the only thing that has that is the life insurance. And then finally, creditor protection of cash values. At least in Texas and many other states, we have the creditor protection of cash values, which I think is an important feature. So after that, I'll usually go through this historical tax returns presentation. And the important thing with this is just simply highlighting that today we're in a relatively, what I would say, low tax environment. So I'll point right here and say, look, this is taxes today, and it may not feel like it, but we're in a relatively low tax environment. It's been as high back in the 50s as 90%. And I'll usually ask them, given, the debt of the federal government and so forth, where do you think taxes will be in the future? And invariably they say they'll be higher. Most people say that, but, a few people say, well, I don't know, but that's rare. Now, finally, we're getting into the good stuff, the actual presentation, and I'll walk you through how I do this. But first, we start off with, look, I'm just going to show you a presentation where you're putting 12,000 a year in for 20 years, total outlay of 240,000. We have a hypothetical rate of return of 6.2428 and all of the options here. And then on the insurance, this is getting you a death benefit of almost 300,000. So then if I go over here to this page, I just simply want to highlight, look, if we put the same amount, the 12,000 for 20 years into all of these alternatives, the insurance, the taxable investment, the tax deferred accumulation vehicle, and the qualified plan, this is the income that you could draw out after tax, beginning at age 66 to age 100. And you're gonna start off with almost 30,000 in the insurance, 20,000 in a taxable investment. The annuity will be about 18, and the qualified plan will be about 26,000. So as you can tell, the only real difference here is the fact that the insurance over here doesn't have any taxes. And that's why it's somewhat higher than the rest. It's maybe dramatically might be a stretch, but it's certainly higher. And the other thing that we assumed here is, if you can look right here, we just grossed up the contribution to the pre-tax amount on the qualified plan. And we assume the same taxes today as in the future. So so that's why the qualified plan is going to be the closest. So relatively straightforward proposal. After this, really the only thing that I typically do is I'll say, look, you know, here's the ledger, and I typically will point out, you know, look, I'll point out like the first year and just say, look, this is a long-term deal. You got to really stick with it for a number of years. And I'll kind of highlight that. And you know, typically I'll tell them, look, this is all academic, and I don't have a ton of time to go through it today because I wanted to keep this to 15 minutes, but this is all really academic until, number one, you qualify for it, but also this isn't going to be the exact outcome because this policy is indexed, and I'll typically go over some of how the indexing is working. And this is just the rest of the pages, but I'll just show you this real quick. I'll typically show this best worst analysis. And this is based on the company that we used in the illustration, actually. And they have a NASDAQ point-to-point index with a 0 floor and a 10 cap. And I'll just simply show them, look, the worst 20-year period was somewhere around 5.7. The average, in this case, is close to the median, which is 6.85. And then the best 20-year period was a little bit over 8. So realistically, we should be able to expect somewhere between the 8 and the 5.7. With it trending more towards the middle over the long run. You know, I try not to overpromise, or at least with the people that we work with, we want to make sure that you're able to underpromise and overdeliver in the future. So again, I didn't want to go too much into that. I don't want to take up more than the 15 minutes. And then this just kind of goes on to have some more information about that. So I'll leave this up right now, and I'll answer any questions. But you know, let's get together. I'd be happy to go over this presentation in more detail. I'd love to show you what we can do for advisors to help them increase their revenue from insurance. That's one of the things that we do to make it easier for you to write larger cases and write more of them. And that's kind of our goal here. So if you have any questions, feel free to use the I guess the Q&A and or the chat feature. I think both of those should work. And I'll stop with this laser pointer, and I'll stay on for a few more minutes and go from there. Question is, in the comparison, do you account for the expenses incurred in the qualified plan? We're assuming a flat 1% expense on the qualified plan, but we can add in like admin costs if we wanted to, and or employer mandated contributions, like if you're dealing with a business owner. So the answer is yes, and then some if we wanted to. You sued this on a virtual. I'm not sure I understand the question. Have you, use this on a virtual basis? Yeah, I have many times. I present it about the same way. The question is, have I used this on a virtual basis? And yeah, I do present this virtually periodically. I have advisors also that have presented virtually. Um, you know, I mean, you could put it in a PowerPoint just like I did here, and or just kind of scroll through it on a PDF. It comes out as a PDF. So, you know, it's just kind of it could go either way. So that's a good question. Then the other question that came in is, how do most folks respond to investing with life insurance? Well, really, I don't have any, I've never had really any pushback on it. I just present it as if it's a matter of fact. Like, I don't know if you know this, but you can also save in life insurance. And it has some interesting features that most people are unaware of. And usually it just doesn't even come up. Whenever I present this, and I'm gonna go back into the proposal, I make sure to really hammer on, like, look, year one's a bad deal, right? I mean, I will say that to them, like, look, we put in 12,000, your surrender value is 2,400. It's a bad deal, isn't it? And they'll say, yeah, it is. I said, look, you need to be able to commit to at least 5 years on this, or it's not gonna work for you. And so if you can't do that, don't do it. I'm gonna tell you right now, don't do it. So I usually go with that, and honestly, I've never really had anybody say, oh, you know, you shouldn't, you know, I haven't had any real pushback. So, um, yeah, that's my best answer on that. Back to here. Those are good questions. Thanks. Whoop, whoop, too far. There we go. So again, we at Advisors Resource, you know, we want to help advisors and agents increase their revenue from life insurance. And, you know, we do it in a couple of ways: competitive products, competitive compensation, customized tailored presentations, underwriting support with our Life Made Simple process, and policy management. Sorry, I'm reading a question. I'm not sure I understand it. I think they're asking what's the best feature here and with life insurance for saving for retirement. And the best feature about it is that it grows tax deferred, and then you can take it out tax free. That's what most people are attracted to. That's what most people want it for. Secondarily, you have the value of the indexing with the floor of 0. So basically, there's no risk, there's no downside risk due to market performance. You could certainly lose money in 1 year if you got a 0 and you still had to pay insurance costs, but other than that, there's no downside risk. All right. Oh, that's it. Cool. I think that's all. Well, thanks again, everyone. Gone a little bit over my 15 minutes, but I was just answering questions. What we'll do is we'll reach out to everybody in response to this meeting and answer your questions. We'll also be sending out a recording of this. Again, trying to keep it under 15 minutes, obviously, and we'll catch up from there. So thanks for everybody who joined today, and thanks for all the good questions. And we'll try to reach out to follow up. Thanks.